Hi everyone, and welcome back to my channel. In this video, I'm going to dive deep into the core elements of the balance sheet. This is a key concept for anyone involved in bookkeeping, accounting, or finance, and understanding it is crucial for both students and professionals. I highly recommend watching the entire video. Don't skip any part, as there is plenty of useful information packed in here. After watching this video, you'll have a much clearer understanding of elements of balance sheet and how to apply this knowledge in practical situations, whether you're in a classroom setting or working in a real-world environment. So, stay tuned and let's get started. With the rise of highly automated software like QuickBooks Online, Sage or Xero, the bookkeeping job has become much easier. However, it's still crucial for beginners to have a solid understanding of the fundamental components of financial statements, especially the income statement and balance sheet. One key point to understand is the correct classification of expenses and income. For instance, when purchasing a fixed or current asset, it is indeed an expense incurred by the business, but it must be classified correctly in the financial statements. If a business incurs an expense for something like shop fitting, this should be recorded as a capital expenditure on the balance sheet under fixed assets. It's crucial to avoid posting it as an expense in the income statement, as this could lead to inaccurate financial data. Misclassifying a capital expense as a revenue expense not only distorts the financial position of the business, but also increases the risk of tax non-compliance. Remember, capital expenses related to fixed assets should always be treated as non-revenue expenditures, meaning they belong on the balance sheet, not the profit and loss statement. Similarly, not every payment a business receives should be classified as income. Receipts can include various sources of funds, such as directors' loans, bank loans, or payments from trade creditors. For example, if a director deposits personal funds into the business, and this transaction is mistakenly recorded as sales, which belongs in the income statement, it will lead to overstating the profit. As a result, the business may end up paying more corporate tax than necessary. Additionally, if the business is VAT-registered, you could inadvertently apply VAT to the transaction, further complicating the situation. This highlights the importance of understanding the elements of the balance sheet and accurately classifying transactions to ensure the financial statements reflect the true financial position of the business. It's essential to accurately differentiate between these transactions to ensure proper reporting. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It consists of three main components that are assets, liabilities, and equity. 1. Assets are everything the company owns or controls that has a measurable value. They are split into two categories. Current assets. Assets that are expected to be converted into cash or consumed within 1 year, or expected life of 1 year. Examples include cash and cash equivalents, accounts receivable, which is the money the business will receive from its customers, inventory or stock, and prepaid expenses. Prepaid expenses are payments made by the business in advance, such as an insurance payment. Often, insurance companies seek upfront payments, and some customers may end up paying the entire year's insurance up front. Additionally, short-term investments also fall under current assets. Non-current assets, or long-term assets, are assets that are expected to provide economic benefits over a period longer than 1 year. Examples include property, plant, and equipment, often referred to as PPE, intangible assets like patents and trademarks, long-term investments, goodwill, and deferred tax assets. 2. Liabilities are what the company owes to external parties, and they represent future obligations that require payment. Like assets, liabilities are also divided into two categories. Current liabilities, obligations the company must settle within 1 year. Examples include accounts payable, which is the money payable to the suppliers. Short-term borrowings, this could be a credit card. Accrued expenses such as wages and taxes, the current portion of long-term debt. And finally, unearned revenue, also known as deferred income. Non-current liabilities, or long-term liabilities, are obligations that extend beyond 1 year. These can include long-term loans from banks or directors, pension obligations, and lease obligations. 3. Equity. Equity represents the residual interest in the assets of the company after deducting liabilities. It essentially shows the ownership value in the business. Owner's equity, also known as shareholders' equity, stockholders' equity, or net assets, is calculated as equity equals assets minus liabilities. Key elements within equity may include share capital, which is funds raised by issuing shares to shareholders; retained earnings, which are accumulated profits or losses that have been reinvested in the business; additional paid-in capital, which is extra amounts paid by shareholders over the nominal value of shares; other reserves, for example, revaluation reserves or foreign currency translation reserves; and lastly, non-controlling interest, which is the portion of equity in subsidiaries not owned by the parent company. Basic balance sheet equation. Assets equals liabilities plus equity. This equation represents the fundamental accounting principle that every asset acquired by a company is financed either by borrowing, which are liabilities, or by the owner's investments, which is equity. Final thoughts. The balance sheet provides a snapshot of a company's financial position, showing what it owns, which are assets, what it owes, which are liabilities, and the residual value, which is equity, available to shareholders. It plays a vital role in assessing a company's liquidity, solvency, and overall financial health. Stay tuned for more useful videos. Don't forget to like, subscribe, and comment.